Are you a business owner feeling overwhelmed by the complicated taxation rules surrounding C-Corps? You're not alone. Many entrepreneurs find themselves scratching their heads when it comes to navigating the difficulties of C-Corp taxation. But don't worry, because in today's video, we're diving deep into the advantages of incorporating as a C-Corp and how it can streamline your tax strategy. Stick around till the end of the video to learn how double taxation can be managed with one effective method. Welcome back to our channel, where we break down complex business taxation topics into easy to understand guides. I'm Jan Prinsloo, a senior tax accountant at Cleer Tax, as well as an enrolled agent. Today, we're talking about the benefits of incorporating as a C corporation. From tax advantages to attracting investors, a C Corp could be the best move for your business. So let's jump right in. Before we start, let's establish what a corporation and a C corporation actually are. A corporation is formed by filing articles of incorporation with the states, which makes it a separate legal entity from its owners. By default, these corporations are taxed as C corporations under subchapter C of the Internal Revenue Code. This means the corporation is taxed on its profits, and then shareholders are taxed again on any dividends they receive. That's what we call double taxation. One major advantage of a C Corp is the ability to raise capital quickly. C Corps can issue multiple classes of stock and have an unlimited number of shareholders. This makes it easier to attract investors and raise large sums of money, which is a big deal if you're looking to grow rapidly. Unlike S Corps, which are limited to 100 shareholders and one class of stock, C Corps provide much more flexibility. Let's talk about risk. Every business venture comes with its fair share of bumps in the road. However, just like LLCs, C Corps offer limited liability protection. This means that shareholders' personal assets are protected from business debts and liabilities. If the business runs into trouble, shareholders can only lose their investment in the corporation and not their personal assets. Now, moving along to taxes. Did you know that C Corps offer some unique tax benefits that other business structures can't? For example, they can deduct employee salaries, bonuses, benefits like health insurance, healthcare plans, and disability insurance, 401k contributions, vacation, and sick leave. C corporations can deduct it all with a few exceptions. But that's not it. C Corps are the only entity type permitted to take advantage of the foreign-derived intangible income discount, which could reduce the effective tax rate on sales to customers outside the US. Finally, C Corps can carry over business losses from one year to the next like a financial time machine, offsetting tax liabilities and lowering future obligations. Plus, C Corps may be eligible for a slew of tax credits, from the R&D credit to the general business credit and even the foreign tax credit. Another perk is the flexibility in profit distribution. Unlike pass-through entities where profits are taxed whether distributed or not, C Corps can decide when to pay out dividends. This allows for better tax planning and the ability to reinvest earnings into the business to fuel growth. Offering stock options is a fantastic way to attract and retain top talent. C Corps can issue stock options as part of compensation packages, providing employees with a vested interest in the company's success. This is a common practice among tech startups and big corporations alike. Now, let's unpack the concept of double taxation, a crucial aspect of C Corp taxation. Essentially, it's like paying taxes twice on the same income, once at the corporate level and again at the individual level. Here's how it works. First, the C Corp earns its income, and the IRS takes a slice of that pie at the corporate tax rate, which currently stands at a flat rate of 21%. But there's where it gets interesting. When the corporation distributes its profits to shareholders as dividends, those individuals are then taxed on that income on their individual tax rates or withholding tax rate in the case of a foreign person. However, there's a glimmer of hope amongst the tax fog: effective income splitting. Now, what is income splitting? Income splitting refers to the method by which C corporations and their owners can share earnings to keep the company and its shareholders in lower income tax brackets. Although the strategy does not eliminate double taxation, it can reduce the tax burden at both the corporate and individual levels, resulting in a lower overall tax bill than with a pass-through entity such as LLCs or S corporations. Now, let's talk dividends, the returns on your investment. Shareholders receive dividends from the corporation, but they're subject to taxation at their individual rates. The silver lining is that qualified dividends often qualify for reduced tax rates of 0%, 15%, or 20%, depending on various factors. But there's an additional wrinkle for foreign owners of US corporations. They face a 30% tax rate on dividends unless their home country has a treaty with the US that offers relief. Incorporating as a C-Corp comes with numerous advantages, from raising capital to tax benefits and attracting top talent. If you're considering this structure and want strategic advice on navigating the tax landscape as a C-Corp, set up a consultation with us at Cleer Tax today. We also offer new company packages that include tax consultation, bookkeeping, software setup, and chart of accounts to set up to help you get started on the right foot. Thanks for watching. If you found this video helpful, give it a thumbs up, subscribe for more tax insights, and let us know in the comments if you have any questions or topics you'd like us to cover next. See you in the next video.